Hey everybody, in this video I'm going to be covering the analysis of options chains for beginners, whether it's strikes, whether it's just defining what exactly the matrix is, the IV, volatility, and all that fun stuff, and just a breakdown of just exactly how that option chain works. Probably thinking like a physical chain, not so much, and I'm going to show you a few pictures here of the kind of option chains that you'll see when you're doing options trading. I'm going to jump right into it. But before I get into that, make sure to like this video, comment below your own input on option chains and any other videos you'd like to see in regards to more information about option chains. But make sure to watch the whole video to get the whole impact. Essentially, you got the contract name, you got the last trade, you got the date, strike, last price, bid, ask, change percent, volume, open interest, and implied volatility. Contract name is pretty much a specific contract for a specific date of expiration. I'll get into that here in just a little bit. Last trade obviously is pretty common sense when it last came in. Strike price, I'll get into here in just a little bit. Last price bid on, bid ask. You got the bid ask, and then there's a spread in between them, and that's the spread is what's between the bid and the ask. Change percent from, the previous day or the previous whatever time frame. Percentage of that change of volume is just how many came in. Up and open interest, pretty much how many are pending that of interest, so on and so forth. Implied volatility, I'll get into here too. This is just another version of that, just a little bit quicker of a breakdown and a better visual. This from Tastyworks. It's the kind of one that I usually be looking at for the different expiration dates, things like that. But we're going to jump into what exactly a contract for options is. It's a little bit unusual that they use the visual of, or the actual name of an option contract. It's a contract, but you're not obligated to buy that contract, so you can flip the premiums back and forth and make profit off of that. And options like the equivalent of being interested in exercising about 100 shares of that given company could be quite a lot of monies, especially on something like Tesla or Apple or so on and so forth. Essentially, you're trying to trade between the premiums there, but if you have the intent of exercise, you can make profit off of that at that point. It's really up to you. You really don't have to hold the contract through the whole process. You can hold it for just a few minutes and you can make profit off of that spread. I have an options tutorial video if you want to check that out in the channel for more information and more of a breakdown on that. But this is just going to cover different aspects of the options chain. You got to basically the options chain, the option matrix. It breaks down the expiration dates. It breaks down volatility, breaks down a lot of different things. And depending on the broker and depending on the website you're utilizing, they might show different things. But the main thing is the expiration date and the strike price, which I'm going to be getting into here in just a second. Strike price, you're probably thinking, well, it's not a lightning strike. It's a strike price at which you can exercise that option. Exercising said option basically means that you're buying the equivalent of 100 shares of that given option at that given strike price. Plus, you get a premium on top of that if you exercise. So you would get the shares, 100 shares plus the premium, and someone else is essentially selling you that premium, hoping that it doesn't actually reach that strike price, as then basically the option expires a worthless. And I'll get into expiration dates here in a second just to cover a little bit more elaborate of a detail on that. Obviously, you want your option to hit in the money and make profit off of that. I cover more expansively what in the money, out of the money, all that stuff is, but essentially the more in the money your option is, the more intrinsic value or the more your premium will rapidly go up as comparative to if you're an out of the money further down strike. You know, essentially if your strike doesn't match what the current share price is, if it's below that, you're not going to make as much as if it was in the money or in the actual strike price, in the actual what the current share price is. uh, Essentially, the other thing I was going to cover is the implied volatility. Volatility is pretty self-explanatory. The higher the number, the more volatile that option in that option chain is going to be, which means that you're going to have more of an impact on an up or down scale, depending on which strike you're in and how far out you are on that expiration date. And I'm going to be covering that here in just a second, so make sure to keep listening in. But essentially, the lower the IV is good. If it goes from a lower IV to a higher IV, that means that your impact on your premium price, aka what you paid for it, is going to go up or go down more rapidly depending on that rate. So if you have a low IV going in a really high IV with like an unexpected piece of news, so on and so forth, your premiums are going to spike from that IV or that implied volatility. Expiration dates, you thinking like, eggs and stuff like that. Pretty accurate. The closer to an expiration date on the options chain, the more rapidly your premiums can, decay. They decay over time on a day-to-day basis. If you're 3-4 months out, you might not notice much of a decay, but if you're less than a month out, you might notice a decay every single day. And that could be $5, $10, that could be $100. It depends on the size of your position. So that is very important to understand that decay happens on options. Even during the day, you lose extrinsic value. Extrinsic value is basically like a hyped value on that option. So if you're buying, a deep out of the money option and your option is coming close to expiration, you're going to lose a lot more money a lot more rapidly in that regard because of that close to expiration date. So it's kind of like, you're thinking milk or whatever, so on and so forth. Pretty accurate. They decay pretty quickly. To brokers that I would recommend for options trading, Tastyworks provides a wonderful little analysis tool for different, rapidly expiring strikes or lower IV options to play it safer, or higher IV if you want to try to do a quick flip in between there. Makes it very easy to utilize. A link is in the description below for more information. Same with Trade UI. Trade UI is a relatively new platform. If you want to follow where the big money is coming and flowing into, Trade UI provides all of that in just one great tool. You can basically follow the sweeps and follow the money. And, as he says, follow the smart money sweeps or smart routed orders that sweep multiple exchanges to fill large orders quickly and stealthily. So essentially, they're trying to find the biggest, most valuable option that there is, and then utilizing that in order to make a profit as a retail investor is a very smart idea. Understanding the patterns, there's going to be algorithmic trading in this platform very soon. Maybe even when you're watching this video, and obviously it works on mobile and tablet devices, and you can use it on your desktop. Different analyzing tools, a lot of fun stuff all in one tool. So that's in the description below too. Check it out temporarily as a trial if you'd like. Also a Discord channel if you want to check out the devs chat to learn more about this tool. But essentially, option chains, you got expiration dates, you got implied volatility, you got all this fun stuff all jam-packed into one thing. And if you guys have any questions about the options chains, I covered a lot of different aspects here. Open interest, implied volatility, what the contract name means, what's the last trade date, strike prices like I was covering, strike prices where you can exercise that option if you want to for that 100 shares and plus the premium, but you don't have to wait for that strike price. You can not exercise, but you can sell that premium at any given point to be out of your position. You do not have to hold till expiration. You do not have to hold till the exercise price or the strike price. You don't have to hold that. There's bid and ask and all this fun stuff. If you want to learn more about option chains and more about all that, make sure to subscribe to the channel. If you want more information on, different options trading strategies or stock market basics or things like that, make sure to subscribe to the channel. Make sure to like this video and comment below what other videos you might want to see to learn more about options trading, more about the stock market, more about, investing in general. Cover all that in just one quick video here and there of different breakdowns. I have a stock market tutorial video, an options tutorial video. Both are about 20 to 30 minutes long. They cover all the basics if you're new, and they cover a little bit of an intermediate idea for different parts throughout the video as well. So make sure to check those out if you have not yet already. Thank you for listening in, guys, and I hope you have a wonderful day. And I'll be doing more videos just like this, upcoming videos like Thinkorswim tutorials and more options trading videos to elaborate more on how I utilize options trading and how I do stock market investing and how I do dividend trading and all this other fun stuff all in this channel. So don't forget to subscribe if you haven't already. I already said that like 5 times, but I'm saying it one more time. See you later, guys. Have a great day.